Happy Monday, everybody, and welcome to the last few weeks of the year. This will be the second to last Monday market update of 2024, so strap in. Last week was a bit wild considering how many people are off the trading desks or on vacation, but we did talk about that, so it should not have been any surprise. So let's jump in. Let's recap last week's market. Let's preview the holiday week ahead. Today is December 23rd, 2024, and this is your Monday market update. Markets started the week on a positive note with strong tech performance and optimism surrounding potential pro-growth policies in 2025. Traders did shrug off weaker economic data from China, including soft retail sales and fixed asset investments, focused instead on robust composite PMI data from Europe. Here in the U.S., the Empire State Manufacturing Index fell sharply, but was viewed as Goldilocks since it reduced concerns about inflation without signaling major economic weakness. President-elect Trump announced a $100 billion investment from SoftBank, adding optimism, especially for cyclical and industrial stocks. It is amazing, though, to see how short our memory is. SoftBank made these similar promises in 2016, and most of them have gone unfulfilled. So let's re-promise them, and we'll get a bump from them again. Again, short memories. Tech stocks continue to lead the rally, but there were signs that cyclical sectors were attempting to stage a comeback. By the end of the day, the Dow was up less than 1/4%, S&P was up about 1/3%, and the Nasdaq was up 2/3%. Tuesday had markets starting out with focus overseas. UK wage growth showed a surprise jump of 5.2% versus expectations of 4.6%, pressuring global bond markets, raising concerns about inflation and slowing the pace of potential global rate cuts. One of the big numbers we spoke about needing to watch, U.S. retail sales rose about 0.7%, supported by a rebound in vehicle sales and a 0.4% increase in core retail sales, signaling continued consumer strength despite higher borrowing costs. Remember, the consumer is the key. Over 2/3 of our economy is consumer. Industrial production did show some weakness, pointing to ongoing struggles in the manufacturing sector. Investors were hesitant ahead of the FOMC meeting as the strong retail sales report raised fears of a less dovish Fed stance. By the end of the day, the Dow was down about 1/4%, S&P down 1/3%, and the Nasdaq was down just under 0.5%. That red was just a preview, but not at the start on Wednesday. Markets did start on the green on Wednesday, but that all changed at 2 p.m. Eastern when the Fed's release was out. The Federal Reserve reduced rates by 25 basis points, but surprised markets with a hawkish cut, signaling only 2 rate cuts in 2025, fewer than the previously expected 3. Subtle language changes in the Fed statement suggested a focus on inflation controls over economic stimulation, spooking investors. The market reacted, much like I told you it would, to anything that was not in line with exactly what the markets expected, priced for perfection. So anything less than that will not do. Treasury yield surged with a 10-year yield rising to 4.54%. It's the highest level in months. The U.S. dollar index surged above 108, adding pressure on commodities and equities. Gold broke below $26.50 per ounce, while oil stabilized near $70 per barrel, but failed to rally meaningfully despite geopolitical risks. As you can see, a lot changed in just one small report from the Fed. But note, this does not change my medium and long-term outlook. I maintain my opinion that markets have more volatility coming, and that can provide chances and opportunities. But with so much still in place, I don't think the Fed action, certainly not this one, is a major game changer. The Dow did close down 2.5%, S&P down almost 3%, and the Nasdaq was down almost 3.25%. Thursday started with news of weekly jobless claims falling to 220,000, reflecting continued labor market resilience. Philly Fed index plunged negative 16.5, raising concerns about manufacturing sector weakness in the mid-Atlantic region. Debt ceiling negotiations and funding concerns intensified as efforts to avoid government shutdown were in question. Attempts at a relief rally did fail as a 10-year Treasury did climb higher. At the end of the day, the Dow was up just 15 points, but that did break a 10-day losing streak, the longest since 1974 in the Dow. S&P and Nasdaq were both down just slightly. Friday brought the next big eco data with the PCE and core PCE. As you know, the Fed's favorite inflation number, so they say. The core PCE price index rose 0.2% month over month, mostly in line with expectations, but highlighting persistent inflationary pressures. Gold stabilized near 2,600 per ounce after steep declines earlier in the week, with modest safe haven flows as market volatility continued. Oil prices dipped below $70 per barrel as concerns about supply surplus in 2025 outweighed the geopolitical risks. As the day went on, selling pressure eased as markets focused on the eco data, cooler than expected, and some reported progress on the funding bill in D.C. Maybe there was not to be a shutdown. That was all enough in a near-term oversold market to have a relief rally. By the end of the day, the Dow was up almost 1.25%, S&P up just over 1%, the Nasdaq was up just over 1% as well. All 11 sectors of the S&P 500 were up, and just 53 of those 500 stocks closed down on the day. For the week, not so lucky, pretty ugly, not in a holiday spirit, of course. The Dow closed down 2.33%, S&P down 2%, and the NASDAQ was down 1.75%. Just to add some more color on the week, while tech stocks did lead the market for much of the year, investor concerns about overvaluations and potential underperformance in AI-related earnings began to surface, highlighted by disappointing results from some of those end-user companies like Adobe and Oracle. The Trump trade sectors, financials, industrials, energy, all underperformed due to political gridlock and higher treasury yields, which dented sentiment around pro-growth policies. You can also blame last week's sell-off on profit-taking as investors moved to lock in gains before year-end. Finally, the dollar index hit multi-year highs, creating additional headwinds for commodities and multinational corporations relying on exports. Let's do a quick look at the holiday shortened week. A countdown to get to the last year at the end of the year actions done. We'll come back on Friday for a few last minute to-dos as we get ready for 2025. Of course, this week is broken up by a Christmas holiday. Markets are closed early on Tuesday and all day on Wednesday. The main thing markets will watch this week will be jobless claims on Thursday, and we'll watch for those continuing claim numbers as well. But we'll also get durable goods tomorrow, and we'll get consumer confidence today. Durable goods will be one to watch for the inline number. This is the business buying that is going on. Not too hot, not too cold. That's what the markets want. We'll get some new home sales data also, but overall, a few notable numbers. But this short week and next short week will be more about year-end positioning. So watch for moves that may be a bit exaggerated since many of the traders are off their desks. So that is last week's update and this week's things to expect. We always can watch for the unexpected, of course. I would expect a bit of quiet trade over the next 2 weeks, but we'll see what 2025 will bring. For now, please be in touch if you have end of the year questions. Otherwise, watch for Friday's video on the last end of the year planning ideas, and then one more market update next week for 2024. Until then, let me wish you a very happy holiday season with Hanukkah and Christmas on the calendar together this year. Enjoy whatever you celebrate. Have a great week and a great holiday.